Okay, so then, let's talk about ASPE, right? Whatever we are talking about so far is about IFRS, okay? IFRS require us to use the percentage of completion as the method to deal with long-term contract. Well, there are alternatives in ASPE, okay, in ASPE for the small medium-sized enterprise. So this method is called a completed contract method, okay? So we have went through that problems, right? You have seen it's quite complicated when we are using the percentage of completion, right? Every year we have to figure out what's the gross profit, right? And things got more complicated when it is the onerous contract, right? But for efforts, for the ASPE, you can use completed contract method. It's much easier, okay? I'm gonna show you why. So under this method, profit is deferred to the completion date, okay? Expected loss are recognized immediately. Okay, so in 2020, did you see that? You do not recognize revenue, you do not recognize expenses, no profit. And in this year, you think it's still profitable project, right? So no profit, so don't recognize any profit or expenses, revenue. It's pretty easy, right? You don't have to do anything. And then in 2021, what happened is, then we realized this is actually based on the information available at the end of the 2021. This is the onerous contract. So then you have to recognize the full loss, okay? So you debit expenses, expected loss for 100,000, and you credit the provision, right? The provision for the construction contract. So, so you recognize the expected loss right away, right? This is similar to the IFRS requirement for the percentage of completion. You always recognize the loss the minute you know this information, okay? And then in 2022, this is the year of completion. This is the time you're gonna recognize the revenue. So the revenue will be the full contract price. The expenses would be the full amount of actual cost. And the gross profit is actually a $200,000 loss, okay? The fact that you have recognized 100,000 in the 2021, you only need to recognize the other $100,000 loss, okay? So you can see this is very easy, right? You would think, oh boy, I wish we always use completed contract method, right? It's much easier. And that's why, as ASPE is cheaper, right? ASPE is cheaper than IFRS. You can see the reason, right? So how long this is going to take you, right? It won't take you very long to finish this, right? It's going to take you more time to do the percentage of completion, right? So this is the alternatives in ASPE, okay? Completed contract method. When the revenue recognition, when the outcome of a contract is uncertain, right? You really don't know, right? How the things is gonna end up, right? So then you use a cost recovery method. So what is the cost recovery method? So basically, normally you would recognize the contract cost as a part of your assets, right? But in this case, you just expensed this contract cost right away. And then you recognize revenue only to the amount of the cost. So do not recognize gross profit. So when you debit revenue, credit cost of sales, okay, these two numbers are equal, okay? You do not have, a gross profit, right? You do not recognize. And then you defer any profit on the contract to the completion date, okay, to the completion date. Again, any expected loss will be recognized immediately, okay? So it's similar to the completed contract method. The difference here is for the completed contract method, they do not recognize revenue expenses at all, okay, until the completion date, right? But for the cost recovery method, you do recognize revenue and cost, and they are equal every year, okay? This is called cost recovery. So you only recognize the amount of revenue to recover the cost, Okay, so the revenue is always equal to the cost. So the difference is 0. So you are not recognizing any profit. If there's any profit, you deferred it to the future until the completion, right? To be, because this is there's a large uncertainty with this contract. So it's important to be conservative, right? You know, guess what? I don't know if how much profit but we'll see at the end of the contract. Okay. But the most important thing, of course, is IFRS, right? And the method you want to know is the percentage of completion, right? Method. Any question?
Sorry, I have a quick question.
Yeah.
For the recovery, the recovery method, cost recovery method, when would you know when to apply a cost recovery method or just take the loss when it's the second year?
So for example, if you are under IFRS, right? You are using IFRS approach. If the outcome of the contract is uncertain, okay, it's there's a high, you don't know, right? You don't know for sure if it's going to be a profitable and or a loss onerous contract. So in this case, you can use cost recovery method. Okay. For this one, the completed contract method is only an option under ASPE. So if you are a small, medium-sized enterprise, you are using ASPE, so then you have the option to use either the percentage of completion or completed contract method. Okay.
Okay.
Does that make sense?
Yes.
Okay, so now let's see compare the differences between IFRS and ASPE. Okay, let's compare these two gaps. So in terms of general revenue recognition process, IFRS requirement, you remember, right? The 5 steps, right? Remember the 5 steps? So you have to go through the 5 steps, right? And then for ASPE requirement, okay, so you just have some general principles, okay, general principles. It's not a 5-step approach, okay? And then for allocation of transaction price to performance obligations, IFRS require us to make the allocation based on the relative standalone selling price, okay? In quiz 4, there's one question, okay, asking about how to allocate this the price among the 2 performance obligations. There's a split in terms of the performance. Some students have no problem; they just got full mark. Other students really struggle with this. I give you one example in the class, right? The J-phone example, if you remember, the J-phone example, right? So I thought with that example on the slides, that question should be pretty easy to you guys. So I was quite surprised to see like some students are struggling with that question, okay? So make sure once you see the result, if you still have questions, make sure you let me know, okay? So IFRS require the allocation is based on relative standalone selling price. ASPE, there's no allocation method specified, okay? You can see ASPE is more like loose, right? It's more like open, right? So less constrictions. Then performance obligations satisfied over time. For IFRS, you have to use percentage of completion method, right? For ASPE, you could use percentage of completion or completed contract method, which I just talked about, okay? Income and expenses from biological assets. So when you are thinking about if I run a dairy farm, okay, so if my assets, right, is biological assets, the cows are my milk cows are my assets, right? So then in that case, you know, the value of the milk cow is changing, right? The fair value of the milk cow is changing in the market. So under IFRS, I could recognize income or expenses on the changes in the fair value. If under IFRS, if the value of the cow, the milk cow, go up, I could recognize the income. Okay. Under ASPE, there's no specific guidance for agricultural activities. There's no guidance, okay? Okay, you can see they're quite different, right? They're quite different, and IFRS is more restrictive, and ASPE is more open. It's more open. Risk of earnings overstatement in long-term contract, right? So one of the things the users is concerned that managers is gonna inflate their earnings, right? So they want to make their company's performance looks good, so they can attract the investors' investment, right? So they want to really show a nice earnings, right? So they could use different things to inflate these earnings. Okay, so there's a lot of risk about earnings overstatement in the long-term contracts. Okay, why? Because it's long-term, right? It's stretched over a long period of time, right? There is rooms for manipulation. Okay, and also there are intentional overstatement and unintentional overstatement. For intentional overstatement, because there are estimation involved, right? There are estimation involved, percentage of completion, how much cost you will need to complete the project. This is all about estimation, right? So when the estimation is involved, the manager can take advantage of this, right? To manipulate the earnings, right? So if they want, let's say, recognize more revenues in the current year, well, they will try to underestimate the amount of cost to complete, so that the percentage of completion is higher, so they can recognize more revenue, right? So you can see how they can use the estimation to inflate their revenue, to inflate their earnings, okay? And the unintentional statement, right? You know, you made errors, right? When you do quiz 4, when you do this problem, right? So it's a complicated calculation, right? So by nature, right? Because of the, you know, the calculations, because the estimation, right? The complexity of the contract, you may make some unintentional errors, overstatement, right? Okay. So that's something the auditor will pay close eyes on the long-term contract. So if you learn about auditing later on, and you know auditors will pay close attention on the long-term contract, because there are so many things can be taken advantage, can be manipulated by the managers. Okay. Presentation disclosure. Okay. So in the general requirement, you would want to, you know, disclose the 5 types of activities, right? Is this a sales of goods? Is this a provision of service? Is this a royalty income, interest income, dividend income, right? That's the 5 main types of activities, right? So for the revenue, the income you recognized, you need to present the different revenue streams according to the type of activity, right? So if it's the service income, has to be separately presented from the sales income, sales of goods, right? If you earn investment income, such as interest income and dividend income, you should not mingle these types of revenues with the other revenues. So the users will find this useful. They will be able to tell, okay, so what are these activities? Income, revenue generating activities, right? There are main 5 types. So when you report, present revenue on the income statement, you want to make it clear, right? Under what activities, what types of activities. Activities from non-monetary exchanges. So we are going to talk more about this in chapter, I believe, chapter 8 or 9. We're going to talk more about this. Revenue recognition policy, right? Which policy you are using? What is the revenue recognition policy? So sometimes when you're talking about delivery, right? There are something called FOB, right? FOB, Okay, so basically, the minute, okay, you loaded up all these items and you shipped to the customer, even though this goods is still in transit, okay, if your revenue recognition policy is, it's FOB, okay, so it's freight on board, that means as soon as the items was put on the truck, right, that's already, I can recognize my revenue. Alternatively, it's on the destination, right? So it has to be delivered to the destination. And if that's the point, then you have to wait until the truck reached the destination. So the revenue recognition policy is different for each company. You have to disclose in the financial statement what is your revenue recognition policy, right? Because it matters, right? Because when the truck is in the transit, there are risks, right? Think about the truck is fully loaded with thousands of eggs, right? Thousands of boxes of eggs. And if that truck was in a car accident in the highway, right, all the eggs will be destroyed, right? All the eggs will be broken. So who is gonna take the risk? Who's lost, right? So the revenue recognition is very important. What is the sales of the point? Before the loading, or after loading, or after the reaching the destination, right? Okay, stage of completion. When I talk about long-term contract, right? Percentage of completion, right? Disclose disaggregation of contract revenue in notes. Okay, disclose the disaggregation of contract revenues in notes. And what else? Presentation and disclosure for long-term contract. What is the amount of contract revenue recognized, right? Method of revenue recognition. Percentage of, is this a percentage of completion or completed contract method? Method of estimation, the percentage of completion. Do you use cost to cost approach to make the estimation of the percentage completion, or you are just use engineer estimate, right? Which method you used to estimate the percentage of completion, right? So this has to be disclosed because the users want to know, right? Because it makes a big difference. The users wants to know this information. Okay. Any questions? Okay. Okay, that's chapter 4. Okay, that's chapter 4. Okay, let's see chapter 5.